Welcome to today's Explainer. We're cutting straight through the daily noise to figure out what the data is actually saying about market bubbles and all this current financial exuberance right now. Literally billions of dollars are being moved by retail investors based on pure panic, mostly driven by headlines screaming that the end is near. But, as focused learners, we don't really do the whole sensationalism thing. We rely on structure, we rely on data, and we rely on logic. So let's just get right into it. Let's kick things off with a pretty massive number that the financial media is absolutely loving right now to scream about an imminent, historic market crash: 234%. You are going to see this number splashed across articles, financial blogs, running across ticker tapes, everywhere. And yeah, it sounds terrifying, right? It sounds exactly like a financial system stretched to its absolute breaking point, just ready to snap and wipe out your portfolio overnight. But let's pause for a second, take a breath, and ask ourselves a really simple question. Are we actually in some unprecedented bubble that's about to pop? Or is the reality a whole lot more nuanced? Because to find the truth, we've got to strip away all that emotion, silence the alarm bells, and look really closely at the actual architecture of how these financial markets work. Which brings us to Section 1, the baseline reality. To get to the bottom of this, we first need to understand the baseline reality of how markets are literally designed to function over decades. We're not talking about today, tomorrow, or even next quarter. We're talking long-term system design. The absolute baseline reality is that the secular trend of the S&P 500 is historically bullish. On average, it rises roughly 10% annually over the medium to long term. The market isn't designed to just stagnate. It is practically engineered to go up. But why? Why is the default direction consistently pointing north? Well, the core reason behind this constant upward growth isn't just incredible corporate success and innovation. It's actually the continuous devaluation of fiat currencies. Historically, and we're talking all the way back to the Roman Empire here, politicians and central authorities have degraded the value of money to pay off government debts with currency that holds way less purchasing power. It's a monetary system that effectively acts like a rising tide, pushing asset prices, things like stocks and real estate, higher over time. So that 10% average annual growth, it's not just a measure of companies killing it. It's a stark reflection of your cash literally losing its purchasing power year after year. Now let's move to Section 2, the illusion of fear. This brings up a super fascinating contradiction. If the mathematical baseline is a 10% annual gain, why does investing constantly feel like the sky is falling for the average retail investor? Why does it feel so incredibly dangerous all the time? Well, it's because in the financial media, there is always a reason to sell. Fear sells, and it sells incredibly well. To keep you engaged, clicking, and glued to the screen, financial news networks constantly inject volatility into the narrative. They're always finding fresh reasons for you to panic. But here's the thing, the underlying trend remains stubbornly bullish. Historically, every major market drop driven by this fear simply offers a fresh opportunity to buy into that secular upward trend at a deep discount. Okay, Section 3, the flawed metric, or as I like to call it, the myth. That whole illusion of fear leads us directly to the primary tool being paraded around right now to convince everyone we're in this massive, unsustainable bubble. It's called the Buffett indicator. Let's define it really quickly so we're all on the same page. Basically, it compares the total market value of all U.S. stocks to the size of the U.S. economy, the GDP. And the logic seems straightforward enough at first glance. If the stock market's value is growing vastly larger than the actual economic output of the country, well, stocks must be overvalued and due for a severe correction, right? And boom, we are right back to that massive number, 234%. The Buffett indicator is currently sitting at a historic, totally unprecedented record high of 234%. Critics and doomsday analysts look at this one data point, and they just scream that it represents pure, unadulterated, unsustainable exuberance. They argue with absolute certainty that the market has completely detached from reality, that gravity is about to kick in, and a catastrophic crash is mathematically guaranteed. But we need to look closer, because honestly, this metric is fundamentally flawed in today's modern world for three huge reasons. First off, it completely ignores global revenue. We've got these massive US tech and pharma companies generating compounding profits overseas, like pharmaceutical giants basing their tax operations in Europe. Yet this indicator only compares their immense global value against domestic US GDP. It doesn't make sense. Second, it totally fails to account for our modern digital economy. Today's market is heavily concentrated in mega-cap software, data, and AI companies. These are asset-light, high-margin businesses that simply didn't exist in the same way decades ago, which makes historical comparisons incredibly skewed. And third, it ignores the current macroeconomic environment and different interest rate cycles. You just cannot compare apples to oranges across entirely different monetary eras without making massive adjustments. Furthermore, let's just do some basic math here. If corporate stock valuations naturally grow at an average of 10% annually, while nominal GDP, even in a really solid economy with roughly 3% inflation, grows at around 6%, simple math dictates that this ratio will always climb. The numerator is fundamentally outpacing the denominator. If you project this mathematical reality out 20 or 30 years, the Buffett indicator is eventually going to hit 700% or 800%. It is structurally designed to go up forever, which basically makes it utterly useless for timing the market today. Let's move right along to Section 4, a better metric, getting back to reality. So if we toss out that deeply flawed indicator, how do we actually measure market exuberance reliably? How do we see what real investors are doing and cut through the media's fear-mongering? We look at the S&P 500 put/call ratio. This is a far superior tool because it doesn't measure abstract, outdated economic concepts. It tracks real money and real behavior in the options market in real time. It simply compares the volume of bearish put options being bought by investors versus the volume of bullish call options. To translate this financial jargon into actual human behavior, heavy volume in call options shows a distinct lack of fear. Investors are opening long positions and risking capital because they truly believe the market will continue to rise. On the flip side, buying put options is essentially investors buying portfolio insurance. When the masses are absolutely terrified of a sudden drop or a looming crash, they rush to buy puts to protect themselves, which drives that specific volume sky high. Right now, the S&P 500 put/call ratio sits at approximately 0.60. Guys, this 0.60 is the number you should actually be paying attention to, not that 234% headline. A reading of 0.60 means the masses are confidently buying calls and they are largely refusing to buy put protection. Simply put, the broader market has zero fear right now. Institutions and retail investors alike aren't buying insurance, they are betting heavily on continued growth. Finally, Section 5, an actionable strategy for market exuberance. Okay, so we've established that the long-term trend is up, the media sells fake fear, the Buffett indicator is broken, and actual investors aren't currently scared. So what do we actually do with this data? Well, counterintuitively, a 0.60 put-call ratio means that right now is not an ideal buying opportunity. Since there is no fear, the market is somewhat complacent. The data suggests you should be incredibly patient. You hold your current profitable positions, you tighten up your stop losses to protect those gains, and you just wait. You're waiting for that ratio to approach 1.0. When it eventually hits 1.0, it clearly signals that the media has successfully terrified the masses, investors are panic buying put protection, and a true high-probability buying opportunity has finally arrived amidst all that chaos. Ultimately, you have a choice to make as an investor and as a focused learner. Are you going to let sensational headlines and flawed historical metrics dictate your financial decisions, leading you to panic right when you should be calm? Or will you be patient, block out that relentless daily noise, and wait for objective behavioral data, like the put-call ratio, to reveal the true opportunities? The market is mathematically and systematically designed to go up over time. Make sure you're using the right tools to capture that growth, rather than being shaken out by the illusion of fear. So what's your next move going to be? Thanks for joining me on this explainer, and I'll catch you next time.